Hi everyone. So in this video, I shall be discussing the solutions of CM2 A for IAI March 2022 examination. So before we start discussing the solutions, just one update which I would like to inform you all is that the next set of examinations which would be held by IAI would be in July 2022. Beyond that, when the next session would be held, whether it shall be in September, October, or November, is something which is yet to be communicated by II. So we need to wait for their communication, which would be available on their website. Also, for the classes which we Finatics hold, we would be starting with our live online classes as well as offline classes to begin with from Kolkata from May. This would be relevant for September 2022 session for students appearing from IFOA. Even students who want to sit for exams from II from July, they can also start from that time, but it is preferable that will start immediately without delaying any time. And even for the ones who want to prepare for the next IIA session after July 2022, you all can also start from May itself. We would be having a single batch only for each paper, each session. So ones who are interested to join our classes, please do so at the earliest. We would be conducting live online classes regularly on weekdays as well as weekends. Offline classes would be in Calcutta, as already mentioned, and all our students would be getting access to pre-recorded lectures, which will give them the flexibility to self-pace their course. Coming back to the paper CM2A, I would say this was a reasonably good paper. You could say this to be an average or an above average paper. Some questions were pretty straightforward, pretty scoring, but definitely some of the questions would have required students to be extremely well prepared, specifically with the content of CM2. There was also a particular question which I feel is beyond the scope of syllabus. The treatment of that is something which is not covered. So I shall be coming to that question as well. So starting with the first question, we have a European put option which has been purchased for rupees 2. It has a strike price of 100 and the underlying current share price is 101. So it's a out of the money put option. So basically its intrinsic value is nothing but 0 over here, and the time value is nothing but the total value of the put option, which is 2 minus intrinsic value. So that becomes my 2. So it basically becomes option number 3. Part 2, in an efficient stock market, following statements are made about the stocks. The price of every security fully reflects all available information. The price of every security is their true value. There is no information asymmetry. So actually all of these three are correct. Again, if you might think that any of them is not fully correct, you can refer to the CM2 material, and there in the first couple of pages of chapter only, in fact even in just the first page where the exact content starts, you will find that in the first paragraph, all these in the first couple of paragraphs, all these 3 points have been mentioned. So it would be all of them are correct. Next is, which of the following invalidates continuous log normal assumption? So mean reverting nature of returns. So log normal models does not have that property. I mean, if anything, it has independent increments, which is something which is contradictory to mean reversion nature, wherein let's say if the returns have been over the mean, there might be a tendency to get suboptimal returns in future. Alternatively, we could say that if the returns have been less over a period of time, then there might be a tendency for the returns to be higher in the coming periods. Again, what happens in reality is a different thing, but this is just the theoretical part. Volatility is constant over time. That is correct. Momentum effect of returns. So momentum effective is basically if the stock prices are increasing, then the momentum effect says that it is bound to increase further. And if a stock price is continuously decreasing, then it means that it will decrease further. This again basically invalidates what your increments being independent. Finally, drift is constant over time. So what we have is basically options A is incorrect and C is incorrect. And so we are left with only option number 3. Finally, which of the following statements is are correct? So this is basically direct bookwork only. And again, if some of you are not able to find these exact things, Google it out. I was also referring to, given that the terminologies used are very much similar, event spaces, sample spaces. So I took the help of Google, just searched through various links to get an idea as in which of them are correct. So this is the answer key. For part 1, it's option 3. Part 2, it's option 4. Part 3, it's option 3. Part 4, it's option 4. And then finally, part 5 is a portfolio manager is building a portfolio with forward contracts which pays twice of share price at maturity. She is trying to Vega hedge the portfolio. If the portfolio is Vega hedged, when I say that the portfolio is Vega hedged, then basically if the underlying Vega changes, it will have no impact on the portfolio. So the portfolio will be insensitive to changes in volatility of the underlying share. This actually looks, to be true. The portfolio will be insensitive to changes in interest rates. That is clearly wrong. Vega has nothing to do with interest rates here as such. 3, could not estimate volatility of the underlying shares accurately. This is again something which is the case, some of you might feel a bit tricky, but then if we see the options, we'll need to come up, with which is the best possible solution. The portfolio will be sensitive to changes in volatility of the underlying share. So clearly, B and D clearly looks wrong. So it's between A and C. A definitely looks right. C is something which all might think whether it's correct or not. So if we take other options, there is no single option A. So definitely it has to be option 4, which is both A and C. And so in the answer key as well, part 5 is nothing but 4. Next, question 2, according to utility theory, the minimum and maximum presented. This is standard bookwork. This particular formulas are there. So the first part is nothing but option 1. Then question number 2, the investor is having a portfolio of the following options. A European call option for rupees 3, strike price 48, and the price at expiry is 49. So at expiry, the payoff becomes 1. I bought it for 3. I have to sell it for 1. So I'm making a loss of 2 over here. In the second case, I purchased a European put option for 5 rupees. Strike price was 55 and at expiry, it was 50. So my payoff at expiry was 5. I also bought it at 5. So I am getting no profit or no loss from this second trade. So overall, I'm making a loss of 2 rupees. So this becomes my option 1 again. Next, which of the following statements about options are true? Early exercise of an American call option on a non-dividend paying share is not optimal. We already know that. We have a proof of this as well. Second, American call option on a dividend paying share is always worth as much as its intrinsic value. This is also the case. Third, European call option on a dividend paying share is worth less than its intrinsic value. Again, this is the case. Finally, early exercise of an American put option is attractive if risk-free rate of interest increases. Again, we know this. So theory is simply that if the risk-free rate of interest is increasing, then if I'm not exercising my put option, I'm basically deferring the sale of an asset. You could think in that way, or the money which is blocked in terms of my put option, I mean, it remains blocked. So if risk-free rate of interest increases, then my opportunity cost of holding that put option increases. So basically, I would want to exercise the put option rather than to wait some point of time. So this will be all the 4, which is part 1. Then a gambler wins 100 when a coin comes up head and loses 150 when the coin comes up tails. If P is the probability of the coin showing heads, then which of the following is a submartingale? So for submartingale, if I'll not remember, it's again there. Submartingale is the probability where the expected future value should be greater than the current value. So what worst you can do is you can try to find the value of P such that the expected gain comes out to be 0. So 100 into P plus, 100 into P minus 150 into 1 minus P is equal to 0. On solving this, we get excuse me, P as 0.6. So when 0.6 is there, it is break even, right? So submartingale property is that the expected future price should be greater than equal to the current price. This shall be true when P is equal to 0.6 or any value which is greater than 0.6. So option C and D are correct. So which basically corresponds to option number 2 over here. Question 3, which of the following is the suggestions as per myopic loss aversion? Again, to get the answer of this, you can directly refer to material. In case you find a lot of these options are similar in nature, you will get the exact answer from material itself. And the answer key for that, part 3, question 1, it's option 1. That is, investors are more concerned by losses than equivalent gains and tend to focus on short-term returns and volatility rather than long-term earnings. That is why the term myopic loss aversion, myopic here basically is short. It's a technical term sometimes used for short-sightedness. That is why here Part 2, at the beginning of month, an investor has a portfolio of rupees 10 crores. Considering the volatility in the share market, his portfolio may be worth 9 or 11. Determine the investor's certainty equivalent. I would say this is a straightforward vanilla question, very easily solvable. So my directly what I've written is root over CW, where CW is the certainty equivalent, is half of root 9 plus root 11. So in the question, it's not clearly mentioned that the probability of the portfolio being 9 and 11 are equal, but if nothing else is there, we would assume that that is the case. That is the most natural assumption, that these are going to be equally likely. So my C comes out to be 9.9749, and B, how much amount I would be willing to pay for insurance. So I basically need to find the certainty equivalent of the gamble, which comes out to be here. The absolute value is 0.025. Working in crores, this is the amount which I would, maximum amount which I would be willing to pay for my insurance. Part 3, in a stock market, the concerned government announced a cut in corporate tax rate. What would be the effect of this announcement to the individual stocks traded in the market? So keeping all of the factors equal, if the corporate tax rate is cut, basically the amount of taxes which the company needs to pay will reduce. Therefore, its net profit after taxes will increase. If the net profit after taxes are increasing, the shareholders are getting more money. So the valuation of shares should increase ideally, and the prices should increase. And the reason would be, if I assume markets to be efficient, then what an efficient market says is that the moment a new information is come, it is fully reflected in the price. So the moment this announcement is made, the stock prices would be adjusting for that very quickly. And yes, the direction would be that it should increase. Keeping that there are no other factors which are influencing, looking this in isolation, the stock prices should increase immediately to reflect the fact that now more amount of money, let's say the company is earning more amount of profits. Part 4, the adjustment coefficient R in Nernberg's inequality is negative, then which of the following is true? The statement is incorrect, as R is only positive. We have other 4 options. By definition, R is unique and positive. Excuse me. So it's basically option 2 of part 4. Next, question 4. Assuming CAPM holds, find the risk-free rate using the following information. I have the different states. I have one risky asset. I have a market of risky assets, and I also have the correlation between the risky asset and the market. So what I will do is try to find the expected returns of asset 1 as well as my market of risky assets. I will try to find the individual standard deviations of same, and then using, let's say, the security market line, I would be calculating the risk-free rate of return. So expectation A, I'm calculating using first principles, then expectation A square, where A is basically referred to as returns on asset 1. Then I get variance A. Similarly, I do that for market. And then we have the formula that expectation A using the security market line, R plus beta A EM minus R. Note that beta A is nothing but covariance of Ri, Rm divided by variance Rm, which when simplified becomes rho sigma A by sigma M. Putting all these values and calculating, I was getting R to be minus 11.7%. It did look a bit weird getting a negative risk-free rate, but I rechecked the calculation. As again, if any of you find any calculations which are incorrect, or if you think that any of the solutions which I've discussed might not be the best choice or might not be fully correct, please let us know through comments. We will take a look at it, and in the interest of all the viewers of this video, we shall be making changes to recommendations as well, in case we feel that there have been certain incorrect approaches or calculations or solutions discussed. So please feel free to use comments box to come up with any alternative answers you feel is the correct one and not the one discussed in the particular video. Question 5. This is the question which I was talking about. It's a Black-Scholes model, continuous model, and there has been a discrete dividend of 2. So I have went through CM2 material, even SP6 material for that matter, and a lot of online content as well. And there was no particular concise closed form formula for calculating the value of a European put option under Black-Scholes model in case there is a discrete dividend being paid. So not sure how part 2 could be done. One thing could be that you could calculate, let's say, the dividend yield, and using that you could calculate the prices. But again, this is something we need to wait how IAI is going to approach this particular question. As for question 5 part 1, this is the formula which we have for a put option, which is directly available in actuarial tables. Substituting all the values, you get D1 as 0.175, D2 as 0.025, excuse me, and putting all of them, the answer which I'm getting is turning out to be 5.2192. Now some of you might be getting different numerical answers depending if some of you have rounded D1 and D2 to 2 decimal places, you would be getting a different answer. In case you have interpolated, you would be getting a different answer. I actually took help of Microsoft Excel to directly calculate these standard normal cumulative probabilities, and so this is the answer which I'm getting. So this is the exact answer, but again, for the purpose of IA examination, we need to use the actuarial tables to perform these calculations. So your final answer could be very slightly different from this, but again, that would be completely acceptable. Next, question 6. Pied crested cuckoo is a particular species of bird which migrates to India from Africa at around May every year. It stays and breeds for 5 months and leaves India along with its fledglings at around, excuse me, at around first week of October. This year, around 5 lakh birds are expected to visit in the month of May. The number of months are expected to grow at the following rates per month. Assuming independence of monthly growth rate, choose the expected monthly growth rate from the following options. Excuse me. So this would be nothing but 3% into 0.25 plus 5% into 0.6 plus 0% into 0.15, which would be coming out. It's question number 6, option 1, part 3. So this will be coming out to be 3.75%. Assuming independence of monthly growth rates, choose the monthly variance from the following options. So this is the random variable. You need to find expectation of A square, and from there you find the variance A, which I guess would be coming out to be the second option, which is nothing but 0.032%. Next, assuming fixed rate stochastic model, choose the expected number of births in the first week of October. So this would be something on the lines of, it's a fixed rate model, so it would be 1.03 to the power 5 into 0.25 plus 1.05 to the power 5 into 0.6 plus 1 to the power 5 into 0.15 whole into 5 lakh, and my answer, excuse me, is coming out to be option 4, which is nothing but 6,02,794. In part 5, I need to find the two parameters of the distribution. So I have the mean and variance, right? So this is for the log normal distribution. So using this, I calculate mu and sigma square, and these are the parameters of my log normal distribution. Part 5 is basically the probability that, in the first, the group would get a negative remark from its supervisor if the total words in the first week of October is less than the value obtained in part 3 above. So basically, if the total, let's say the number of words coming out is less than the mean number of words, or let's say 6,02,794, then a negative mark would be there. We need to find the probability of same. So the equation becomes that, again, this is incorrect, which I realized over here, because this I just need to recheck this, just came to my mind. This should be 5 lakh into 1 plus I to the power 5 ideally, because it's a 5-year growth. So this needs to be seen as, how this will be calculated. This is apparently long because these are the parameters. If I'm not wrong, these are the parameters for a single year. Yes, these are the parameters for a single year. So part 5 is something incorrect. The solution for same would be uploaded later. Then question 7, it's a runoff triangle. Various information is given. Coming to part 1 quickly, whether the inflation figures for all the above years are useful in the calculation. If not, state with reasons which year of inflation has no relevance. So it will be basically 2018, because all of these data are at the end of the particular year of accident. So the inflation of 2018 will not be of any useful interest. For part 2, I'm just sharing an Excel file with you all where you can just cross-check your calculations. Obviously, in examination, you had to perform everything on the platform itself. You couldn't take help of Excel for calculations. So this was my data over here given. Then I get the incremental claims data unadjusted for inflation. Then I basically adjusted to inflation over here. Then what I do is I find the cumulative claims data. You all can refer to the values. I get the development factors. Then I get the incremental claims. And then I basically take them by incorporating the future inflation as well. And the outstanding reserve, which I'm getting, comes out to be 541. So again, some of you would be getting slightly different answers, maybe to the tune of, let's say, even plus minus 10, depending on the places, the decimal places you have rounded off your, let's say, development factors. So that might vary. Moving forward to question 8, a portfolio named Alpha consists of two assets A and B with rupees 1000 invested in each of the assets. Both of these assets have daily volatility of 1%. The correlation coefficient between the returns is 0.3. The 4-day 99% VAR for the portfolio will be. Now, this I would say is probably the most difficult question in my opinion. I expect very few of them to be able to calculate. Again, a question like these, you wouldn't really find it in the material. So this is the solution. This might take a time to absorb, but this is the correct way to approach. The standard deviation of daily change of each asset is given to be 10. So the variance of portfolio change for one day is basically 10 square plus 10 square plus 2 into 0.3 into 10 into 10, which comes out to be basically 260, right? So my variance of portfolio for 4 days becomes 260 into 4. And my standard deviation will be basically root of 1040, which comes out to be 32.249. Now my 1 percentile of normal distribution is 2.326. Excuse me. So my 4-day 99% VAR will be 2.326 into 32.249, which comes out to be 75. So it becomes option 2. Again, it might take some time to absorb, as how we are going this. It's something you wouldn't really find in the material, but this is the approach for questions like this. Next, part B, another portfolio named beta is constructed similar to portfolio alpha, except the correlation coefficient between the returns of both the assets is 1. So we know that if rho is perfectly 1, then investing in both these assets, we will not be able to achieve diversification as such because they both are perfectly correlated. So and if you're not being able to achieve diversification, another way is that the variance will be a lot more higher. If the variance is higher, then obviously our VAR should also be higher. So compared to both beta and alpha, alpha is a diversified portfolio as compared to beta. That should be kept in mind. And the 4-day 99% VAR should be greater than the portfolio alpha. So basically B and D is correct. So this becomes option number 2. Excuse me. So you will see B, it's option number 2. So this was part 1. Next, it's part 2. The investment returns of an asset have the following probability distribution, the variance. So you can calculate the variance, semi-variance. Here it's a symmetric distribution, so it will be exactly half of variance. So even by looking at the options, you can see that clearly 9% and 3% shouldn't be there because my semi-variance should be half of variance. So it should be either 1, 3 or 4. 3 again, 0 should not be there. 0 variance means that the random variable can take only one value, which clearly is not the case. So basically left with option 1 and 4. Again, this is just the way to eliminate in case of multiple choice based questions. Sometimes without even solving exactly, you know what the answer would be if other answers are extremely inconsistent. So here now it's between 1 and 4. So obviously we'll need to solve it properly. You just apply first principles and we'll be getting the answer as 1, which is 9% and 4.5%. Which of the following statement is not true for downside semivariance of investment risk? It ignores the risk above mean. This is true. It gives more weight to downside risk. This is also true. Based on mean as benchmark, which is arbitrary. This is also true. Semivariance is half of variance in all cases. Option 4 is not correct. This is only true for ones which are symmetrical about their mean. Other than that, semivariance is not always half of variance. Part 4, a person who is currently having cash of 48,000 wants to go for a tour at end of 1 year from now, which will cost him rupees 50,000. The cash can be invested only in two assets, namely X and Y. X gives you guaranteed return of 4%. Y gives returns which are uniformly distributed between 2 to 6%. Find the probability that the tour will not happen if 100% of cash is invested in asset X. So if I invest in X, I get a guaranteed return of 49,920, which is less than 50,000. So it's certain or 100% probability that the tour won't happen. In second case, 48,000 is my initial amount. Then this is basically the returns which I'm getting. So 48,000 into 0.8y, 80% I'm investing in y, and y is the incremental or additional return, and I'm investing 20% in x, and the combination of these, it should be less than 50,000. That is what has been asked in the question. So this will come out to be 0.8y plus 0.2x is less than 1 by 24. Now note that x gives you x takes a fixed value which is nothing but 0.04, which is basically the interest which you're earning. So you get y is less than 101 by 2400. Now y follows nothing but uniform 0.02 comma 0.06. So you can directly find the values of the CDF from actuarial tables itself, the formula for it. So it's basically x minus a whole divided by b minus a, where the random variable follows uniform a comma b distribution, and this comes out to be roughly 55.2%. Next, question 9. This is a typical excuse me, binomial model. So I'm not reading the question, quickly going through all the solution. First part answer is coming out to be 0.782185. In the second part, it's coming out to be 0.282185. And finally, we need to find delta. So here this will be come out to be minus 0.5. Note that a minus over here is missing, but if we calculate this, numerator is positive, denominator is negative. This will come out to be negative minus 0.5, which is expected. We know that the delta of a put option has to be negative. So that becomes the commentary as well. And finally, towards the last question, which is basically on my ruin theory. So I need to find the first part is calculating the probability, and second part I need to find the reinsurer's security loading. So you all can just go through the solution. Always try to define random variables, go step by step. This will ensure that you're not making any such silly errors. So X follows a generalized Pareto distribution, that is 3 parameter, 4, 75, 3. N follows Poisson 120. Initial capital is 1500. So first I define my surplus value at time 1, which is initial value plus the premiums achieved in 1 year minus the aggregate claims in paid in 1 year. So my premiums achieved would be 1 plus theta into the expected claim amount, which can be broken into expectation X into expectation N. And I'll be getting this as 9,000 into 1 plus theta. Using this, I need to find the value of theta, and that if we'll substitute all the values over here, we'll be getting as 11.3492%. So this is basically the premium loading which the insurer can use. In part 2, a reinsurance has been taken. 75% retention is with the insurer, so 25% is being ceded. So net premium is basically the premium being charged by the insurance company, which is applying a 15% loading minus the premiums being ceded to the reinsurer. So 25% of 9,000 is going to be 9,000 is expected claim amount. 25% of this would be ceded, or given reinsured with the reinsurer. Ceded is a typical term which you will might have heard if you're working in corporate, or again a term which you would be listening to. The amount being reinsured, it's also sometimes referred to as the amount being ceded. Into 1 plus R, where R is basically nothing but the premium loading which the reinsurer is using. So this is coming out to be 8100 minus 2250 R. The expected claim amount which the insurance company will pay will be 75% of 9,000, which comes out to be 6750. Variance of SI, again it comes out here, and then we know that just with the previous part, this is the 1 percentage point. This should be equal 1.5 percentage point, which should be equal to 2.1701. Solving this, R comes out to be 42.619%. So overall, again, when you see that the paper was, you need to get 50 marks overall in CM2. So I would say at least for CM2 A, this paper was scoring. Well-prepared students should have at least been able to get at least 60 marks correct. And the ones who are very well prepared, very well versed with the entire curriculum, they would have been able to attempt even 85 to 90 marks plus accurately. So hope that you all did found this video useful. Don't forget to subscribe to our channel so that you do get updates regarding all the content which we keep uploading. And in case you did find this video helpful, please do like the video and let us know in the chat section as well. Thank you everyone.